C Limited jumped 14.6% on August 11, 2026, closing at $131.51, because its second quarter revenue came in at roughly $7.8 billion, up about 48% from a year earlier, and well above the $7.1 billion analysts were expecting. It was a big top-line beat, and the market rewarded it right away. C had a brutal stretch starting last fall. The stock peaked in September 2025, then slid hard for months. The worst day came in early March, when the company's fourth quarter earnings report missed on profit and came with conservative guidance for 2026. C fell more than 16% that day, and the slide kept going until the stock bottomed at $78.16 on March 27th, down more than 60% from its September high. Then the recovery started. The first quarter earnings report in May delivered another strong revenue beat, and the stock jumped about 13%. So by the time August 11th arrived, C had already roughly doubled off the March bottom. The comeback was underway, but it still needed confirmation. The second quarter report was that test. It passed. Revenue came in around $7.8 billion, up about 48% year over year. Wall Street had been looking for somewhere between $7.09 billion and $7.18 billion. So the company beat expectations by roughly $600 to $700 million, about 9% above the middle of the consensus range. For a company C's size, that's not a rounding error. The market's answer was immediate. Shares jumped 14.6% during the session, with the gain coming early and holding all the way through the close. It wasn't a morning pop that faded. It was a repricing. Why does a revenue beat move a stock that much? Because the stock market doesn't price the past. It prices expectations. The consensus revenue estimate is the market's collective guess about how well a company will do. When a company like C blows past that guess by nearly 10%, investors don't just say, "nice quarter." They revise the whole picture of how fast the company is growing. And for C, growth is the entire story. It runs Shopee in e-commerce, Garena in gaming, and a fast-growing financial services business. The value of that company depends on how big those businesses can get, and revenue is the scoreboard for that question. So a beat of this size says the engine is running faster than the last estimate suggested, and the stock gets revalued accordingly. There's also a relief element. The March sell-off was about profit coming in short and guidance being cautious, not about revenue collapsing. This quarter showed the top line is still accelerating. It doesn't answer every question, but it answered the question investors were most nervous about. 3 days later, the stock had given back a little of that pop. By August 14th, C closed at $121.94, down about 7% from the post-earnings high. At $121.94, the stock was still far above the March bottom, so the recovery story remains intact for now. What's not settled is whether one strong revenue quarter can resolve the deeper worries about profit margins and whether the company can keep up this pace for the rest of the year. A beat like this is strong evidence, but it's not a verdict. The market has priced in a much more optimistic future than it did in March. It just hasn't seen that future show up yet.